Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. As Global Co-Head of Portfolio Solutions at AQR Capital Management, Dan Villalon is primarily engaged in helping the firm's clients address constantly evolving challenges around risk management. Central to these, of course, is the search for efficient sources of diversification. In this context, our discussion explores research his team has done in two primary areas. First, we talk about defending against drawdowns that are both fast and slow, and backtests that compare options-based hedging with strategies like trend following that do not require explicit premium payments. For rapid market sell-offs, like those that occurred during the GFC and COVID crash, explicit premium-based insurance works well. These strategies can suffer, however, as the market bottoms and recovers even as option prices remain high. Trend-following strategies, while not as effective for sudden market plunges, tend to be more effective in offsetting losses that occur during slower drawdowns, as occurred in 2022. Dan makes the point that a robotic strategy that buys assets that have trended higher and sells those that have trended lower tends to work across asset classes and around the world, at odds with market efficiency. One possible explanation put forth is underreaction. Here, investors respond to good news, but not initially by enough, leaving further gains on the table. Lastly, we talk about AQR's recent work on international diversification. Noting that U.S. stocks have been the place to be for 3 decades, the firm sees an important role for international equities going forward, given the view that the tailwind of rising relative valuations in the U.S. may be behind us. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Dan Villalon. My guest today on the Alpha Exchange is Dan Villalon. He is Global Co-Head of the Portfolio Solutions Group at AQR Capital Management. Dan, it's great to have you on the Alpha Exchange.
Thanks for having me, Dean. I'm looking forward to it.
Looking forward to the conversation as well. And before we get it underway, I just wanted to say thank you. You were really instrumental in the preparation that we did for the interview of Cliff at the Macro Mind Symposium that we recently hosted. And I think you provided Arthur Kaz, who interviewed Cliff, with really a good background in the types of questions to ask. So I think that turned out really well. So thanks very much for that.
The feeling is definitely mutual there. Very often, when you're preparing for an event like this, looking over the questions, it's sort of a perfunctory task, but with you guys, it was a blast. I even did catch up with Cliff after our prep call saying I think this is going to be a pretty good program. So I'm glad it worked out.
Yeah, it was great. Arthur is also a University of Chicago graduate and a dear friend of mine. And he took the task on, the ask to interview Cliff, and really put a lot of time and energy into the prep. And I have to say as well that watching the interview live, Cliff is just deadpan funny. I was just laughing out loud. And it wasn't just finance jokes as well, because my wife was sitting next to me and she was laughing out loud as well. So a fascinating conversation just that combined a lot of academic finance along with just some genuine humor. So it's really great. Let's get into our conversation. I want to start with your background. You and I share some lineage from the Booth School at the University of Chicago. Tell us just about a little bit of your career path that led you into this senior role at AQR.
Maybe I'll start with my first role in finance. So this was just a few years pre-Chicago, but I think it's what kind of led me to Chicago. So I was in JP Morgan's private bank. I was an analyst there. That's kind of where I started. And I think, of all of the starting steps in a career path, I think it has to be one of the best, because in a way, it's like a liberal arts education in investing. In the private bank, you're dealing with individuals and you get to see all of the asset classes under the sun, everything from traditional stocks and bonds, things like this, to alternatives, to illiquids, private assets, and so forth. And you start to get introduced to the very real and very important challenge of asset allocation and portfolio construction. It was a great introduction, and maybe I'm a slow learner here, but I had this sort of naive realization, and maybe this was in my second year or so in the analyst program. And what I'm about to say, I don't mean to disparage JP Morgan in any way. This would be true anywhere. This question I had and this sort of challenge that I noticed was a lot of the active funds. So you think of maybe a US large cap active strategy or international or what have you. A lot of them had a tough time routinely, regularly, consistently beating the market. And that was kind of surprising to my 23-year-old self. I thought just conceptually, if anyone could routinely beat the average, it would be one of these big fancy firms that has top-notch analysts and stock pickers and all this stuff. And this was a little bit of a mystery to me. Why isn't it that these well-resourced places can beat the market as consistently as I thought they should? And again, this wouldn't be unique to the firm that I was at. I think you'd find this, and we have found it empirically in many places. And that's the first question, sort of the catalyst that led me to the University of Chicago. I started bugging people around the firm saying, this is interesting to me. I want to learn more about it. I want to learn why. One of the guys at the desk that I worked at was a Chicago grad, and he told me, well, Dan, if you want to drink through a fire hose on questions like these, Chicago is the place for you. So that's what led me to your alma mater, the University of Chicago.
Well, it's so interesting. And for me, what you said there about the broad inability to outperform the market on a risk-adjusted basis as pretty good prima facie evidence for some reasonably strong form of the efficient market hypothesis. At least for me, that matters quite a bit. It's not as if these folks aren't well-resourced, putting the time in, and still really struggling to beat a benchmark on a risk-adjusted basis. My time there was in the mid-90s. So I got out of there in 1996. And let's see what's happened since. You had LTCM blow up. You had this gigantic tech bubble. You had this incredibly low vol period in the pre-GFC era, then the global financial crisis. You had things like the Eurozone sovereign debt crisis, the meme stock episode of 2021, of course, COVID before that. And so you have all of these bursts of volatility, both low and high. I was just hoping you could reflect on the way in which market price outcomes maybe influence your thinking on the broad topic of efficient markets. And I'll preface this by saying that I found it very interesting that at the Macro Minds conference, Cliff had said that maybe on balance, he might see markets as a little less efficient than he saw them a decade or two ago. I thought that was just an interesting comment to make. Price discovery is more instantaneous just in terms of how electronified markets are, but that doesn't necessarily mean they're more efficient. As someone who went through the University of Chicago program, what's your take on just this broad question that we all argue about in terms of market efficiency?
Maybe this was your experience too, but looking back on my time there, I recall a lot of the debate being like an either or. Are markets efficient or are markets inefficient? And it was sort of like, where are you on the spectrum? Do you think it's 80-20 or 20-80? I've never met anyone who's 100% in one camp and 0 in the other. I just don't think those people exist. But what I kind of realized after school and just participating in the industry for a while is, what about changing through time? Can markets become more or less efficient through time? And what does that tell you about the opportunity set? So it's not a hard-coded markets are 70% efficient and 30% inefficient. There's certain times where it seems like it's just harder to reconcile what you're seeing with market rationality. And that was something that I think was a real world lesson as opposed to a University of Chicago lesson. This might be a silly anecdote, but I think it has a deeper kind of insight. At every business school, and it probably, you have these investment management clubs. And the way it works is every week, a member has to pitch the rest of the club on their favorite stock or something like this. And I was looking to go into investment management. And so I signed up for this club. and my week was coming up. So I'm supposed to pick a stock that's going to add value to their portfolio. So I did my research and I pitched the organization on an S&P 500 index fund. And I have seldom gotten such a furious response to any idea that I've ever had. But my objective was to deliver a strategy or a security with high risk adjusted returns. I have to imagine I beat most of the other participants because diversification is a hard game to beat. In one sense, I was right. It's hard to outperform an index. I think my quote unquote stock pick did beat my classmates. But was I missing the point of the exercise? Yes, absolutely. What I kind of took away from that episode at school, which I've carried with me since then, and I think has been very important, is this notion of optimality or the best portfolio or the optimal portfolio. Optimality is not in a vacuum. Maybe in class it is, but in the real world, it's what is the best use of your ability to be different. Maybe people aren't looking for the optimal in a vacuum portfolio. They actually have some sense of how much they're willing to deviate from something else. Maybe it's peers, maybe it's tracking error to a benchmark. And that was sort of my almost silly way into backing into what I think is a very important either preference or constraint among investors, and that is tracking error. How different can you be? And what's the best use of that risk budget? And it wasn't something I kind of learned in a classroom. I think it was something I learned while losing a lot of friends at school. But I think it's an important insight in terms of how investors actually do behave in the real world.
Well, tell us about coming out of the University of Chicago and then your pathway to landing at AQR.
I was fortunate in that my first year at Chicago, I was taking a class called Empirical Asset Pricing. And it was as difficult as the name suggests. The professor was this guy, Toby Moskowitz. And I just thought that it was the coolest class I'd ever taken. And one day after class, I walk up to him and I say, "Hey, professor, is there any place in the real world where I can continue to do stuff like what you're teaching? Can I actually apply some of these insights?" We were discussing factor models, portfolio construction, all this stuff that I thought was really interesting. He looked at me as if I was messing with him. And the reason for that is what I failed to realize was Toby had just gotten back from his sabbatical. The previous year, he had taken off from the University of Chicago to work at AQR. And so he probably thought I kind of knew that I was just looking for an introduction to a firm like AQR, but I had not done my research sufficiently well. And he said, "Oh, there is this one place. It's called AQR. And they are very research-oriented, academic quality, rigor to everything they do." He was the guy who made the introduction to me. The group that I'm in, or I came to, is the same one I've been with ever since here at AQR. It's called the Portfolio Solutions Group. I think when I joined, it was a pretty unusual group to have at an asset manager. I think now there's more of these around, more of these solutions groups. At AQR, there's basically, at a very high level, there's two things that the Portfolio Solutions Group does. One is what's sometimes blandly called thought leadership. And the second is a customized, sometimes thorny analyses. The thought leadership that we do is not so much looking from within AQR and saying, okay, what are the stuff that we're working on that we think is interesting or people should be aware of? It's more looking outside of AQR. So we have this quarterly piece called Alternative Thinking. And the idea there is, what's the big issue facing CIOs, facing asset allocators today? And what can we say about it? What points of view do we have? Or what does the data suggest about sort of the right way to move forward on the big topic du jour? That's something that we published and is just out there for the investment community. We just put it on our website for anyone to consume. The second thing that we do, these thorny customized analyses, this is more for AQR clients as opposed to the broad world. But it's, can we take some of the analytical firepower that we've developed internally and use it to solve some of our investors' actual specific portfolio challenges. We get to kind of exercise, call it both halves of the brain, the writing, the thought leadership, but also just the nitty gritty mathematical exercises too.
Well, if you have a group that's got solutions in its name, you're addressing challenges, you're addressing problems. You mentioned tracking error as maybe one small subset of the set of challenges that CIOs and money managers, allocators deal with. I was hoping you could maybe think back and just try to describe the evolution of some of the work that you and the team have done over different cycles. We've, of course, experienced just so much change from the GFC and that ultra low rate period that came in its aftermath for many, many years. And then COVID, rates got even lower. And now rates are just so much higher. We've had, again, these explosions of volatility in the process. What are some of the thematic areas of work that the team has done on behalf of its clients? If you can kind of think back and maybe just try to talk to us about some of the change you've observed with regard to the emphasis of your work.
I'd be curious to know if this is true for you too. But I think there's a little bit of the more things change, the more they stay the same. That's going on in markets. For instance, in sort of my specific case, the very first white paper I ever wrote at AQR was called Chasing Your Own Tail Risk. I have to credit Cliff for adding the word risk at the end. The sort of the final version of this thing was just chasing your own tail. And Cliff has this trick that he uses in some papers where he adds in parentheses a last word to a title, and it usually is for great comic effect. And I think he definitely hit the nail on the head. This was shortly after the global financial crisis. We had a bunch of investors ask for our opinion on hedging their portfolio from sort of the next GFC or the next drawdown. So this is the first thing I ever really worked on formally at AQR. And it's also pretty much the same topic that I wrote with the team, with the Portfolio Solutions Group that we wrote at the end of 2022. Again, that was another year where, in that case, both stocks and bonds went down, and it became a question again. Now, the nice thing is we do think we've learned a bunch in the past decade plus. And so even though it is sort of the same topic, I think tail risk is always going to be interesting to folks. We do have new research, new insights, and sort of new suggestions or thoughts to share with our investors. In that particular one, I think with tail risk and tail risk hedging and risk mitigation, there's maybe three schools of thought. The first one would be, well, if you're afraid of risk in bad times, then maybe you shouldn't take as much risk in steady state. Set your risk budget according to the bad times as opposed to the average times, so that the bad times aren't worse than you can handle. Let's call that the de-risk approach. Then you have let's do something about it more actively. Let's find a strategy that tends to pay off or tends to deliver when you need it most during those bad times. And there you find these two schools of thought. The one would be more options based. So something involving put options, something involving explicit protection. And then the other would be something that's a little bit more of, call it a indirect hedge, strategies that tend to do well when the world is falling apart or when the world is becoming more volatile, but they don't have the guarantee of doing that, but they tend to, and there's sort of a reason why you might expect it going forward. And so those were the kind of the three things that we looked at in that first paper, and we use it. It's a pretty useful framework with the latest crisis, and I would guess it's going to be a useful framework for the next time traditional markets see a big drawdown.
Well, it's such an interesting question, and it's essentially one that I spend a lot of time asking myself and engaging with my own clients, which is just the price of insurance. Is it a good deal or not? I always use the example of if you bought a house and you're excited and got your mortgage, and the lender told you, well, of course, I can't lend you against the collateral unless you've insured the collateral. And so then you call up your neighborhood homeowners insurance company and you ask them, well, okay, I need to buy some insurance. I just bought this house. And you ask them what the premium is, and they just tell you, well, it's nothing. That's zero. I use that because I think there's a lot of strategies out there that purport to be pure insurance, or they're manufacturing pure insurance without actually paying a premium. And maybe this is the road we can go down. Of course, going into 2022, there were a lot of folks in the institutional money management realm really leaning into bonds as a almost quasi-insurance policy, probably with good reason. I mean, I'd love to get your take on this, but with reasonable consistency, duration would rally in a risk off. And certainly in the post-crisis period, that was very consistent. That negative correlation between stock and bond prices, especially contingent on a downturn in stocks, got pretty attractive. And so you've got treasuries offering some yield and offering a lot of defense up until 2022. Love to get your thoughts on that, just how that occurrence made its way into your analysis, the work that you and the team had to do around observing that not only are bonds not working as a defensive instrument, but they're actually the problem in the portfolio. Talk to us about that stock bond correlation flip from your perspective.
I think you're exactly right. Most investors, and for a good reason, given the information they were looking at, did think of bonds as more of a hedge than as a diversifier. What's the difference between a hedge and a diversifier? Well, a diversifier, if something's perfectly uncorrelated, then it marches to the beat of its own drummer. It doesn't really matter what the rest of the world is doing. This thing is just should work or not independently of those other influences or those other kind of effects. A hedge is something that would be sort of negatively correlated. You would expect it, all else equal, to do better when another asset class, the one with its negative correlation to, does worse than average. And bonds did look like a hedge for the past couple of decades. It had a negative correlation to stock markets. And I think if you look at every, 6-month period or maybe quarter where equities were down over the past couple of decades, bonds were almost always up. And I think people got used to that. One thing that the Portfolio Solutions Group, alongside our macro research team, did was to look into, okay, what are the determinants of that stock bond correlation? What are the influences behind whether or not bonds are going to act like a hedge or a diversifier? What's the fundamental kind of economic risk that might make bonds positively correlated to stocks? In other words, what would set up the conditions for when one does poorly that you would expect the other to do poorly as well? And so what we did here was we said, okay, well, what are some of the most important macroeconomic risk factors? I think most investors would agree that growth and inflation are the two. And then what we decided to do was, okay, well, let's take a look at history. Let's take a look at the past 50 years or so and divvy them up according to whether or not growth was kind of the main macro risk that mattered, or inflation. It's AQR, so we specify the heck out of these things and we make sure that it's robust as possible. Generally speaking, we want to know basically if growth matters more, it's because growth surprises or growth uncertainty is bigger than inflation surprises or inflation uncertainty. So you kind of compare, okay, what were these things forecasted to be versus what do they come in at? If the error was big, then you say, okay, then this is a growth surprise or an inflation surprise. And so what we said is, okay, let's take a look now in those growth dominated or kind of growth surprise or growth uncertainty dominated periods. What's the correlation? What's the diversification, or what's sort of the hedging ability between stocks and bonds? And what we find in those periods when growth is sort of the main story, stocks and bonds are pretty darn uncorrelated. I think on average, it's something like a 0.0 correlation. It's a great diversifier and has the potential for even being more than that, having periods of negative correlation, which is like what we saw from 2000 to 2020. I'm sure you know where I'm going here. What about the other macro risk? What about inflation? Okay, when inflation is driving the headlines and dominating market worries, when realized inflation comes in way off of what expected inflation was, when inflation is sort of the main uncertain macro variable, what do we find? Well, we find a positive correlation between stocks and bonds. Let's rewind just 18 months ago to 2022. Inflation uncertainty, inflation expectations versus realized inflation was huge compared to anything we've seen so far this century. You would expect, if that's the case, if stocks and bonds have sort of a similar dislike for inflation risk, and it is an inflationary environment, you would expect both to do poorly at the same time, which is what we saw. And so when it comes to sort of the broader question of I want to do something about tail risk or the risk of an unusually bad event in my portfolios, I think diversification will always have a home when it comes to risk mitigation. But there are strategies that we find can do a little bit better, that can be a little bit more consistent, particularly in these sort of macro uncertain or kind of inflation risk periods like what we saw last year and, what we continue to kind of see today.
Well, I think that's a good pivot towards some of your work on fast versus slow hedging. And I think in my own area of focus, it's probably more on the fast, explicit optionality. I just got my hands on this book, Chaos Kings. It's written by Scott Patterson, and he's walking through some of the folks that really specialize in options-based tail hedging. And one of the key characters in the book is Bill Ackman, who does not focus on tail hedging, but just so happened to have ran himself into a trade that almost rivals the famous greatest trade ever, John Paulson from the pre-JFC era, getting short subprime. But Ackman essentially bought just a gigantic amount of options-based credit protection in the period right as COVID was getting underway and sold it out at something like 100x return. And so I think what he did there was, I think, different from some of the limitations that you capture in the work that you do. And I'll turn it over to you on the fast versus slow. But effectively, Ackman bought a very low-priced option and, got both the vol kick, giant increase in implied vol, and also, of course, the credit spread widened gigantically in his favor. But he didn't continue to roll it. He unwound it. And I think one of the things you point to in your fast versus slow work is just that if you keep rolling options in a very high environment, it's ultimately going to make the drawdown on the hedge that much larger when the market ultimately does recover. So why don't you walk us through the framework, and that'll get us into some discussion on trend following, which is, of course, work that you guys are explicitly focused on.
The title, I think it was Danny Kahneman wrote the book, Thinking Fast and Slow. And I always thought that was kind of a cool title. And so he sort of inspired the title of this piece, The Fast versus Slow Portfolio Protection. And the basic thought was very often when people think of protection type strategies, they think about the depth of a drawdown. Will my existing portfolio have a 1% or 2% chance of having a 30% drawdown or a 40% drawdown or what have you? And what we wanted to look into in this paper was, okay, well, beyond the depth of a drawdown, what about the other dimension? What about the dimension of time? Does it matter if you lose, say, 30% in a quarter versus if you lose 30% cumulatively over a year or 3 years or 5 years? This is a pretty simple question, but I think a pretty important one too. And what we found was, let's take history and let's look at all of the worst outcomes that we've seen. So what was the worst year for being a 60-40 investor? What was the worst 2-year period? What was the worst 3-year period, et cetera? And then we said, okay, well, let's say you have a 5% return target or return objective. And we say, okay, well, starting with a bad year or starting with a bad 2 years, starting with a bad 3 years, et cetera, what's the likelihood that over your investment horizon, say a 10-year horizon, what's the likelihood you're able to hit your 5% return objective? What does having a bad draw mean to your cumulative wealth at the end of your investment horizon? What we found was that the shorter drawdowns, the ones that happened faster, tend not to really have too much of an effect on whether or not you hit your objectives 10 years later. The slower drawdowns, a 3-year drawdown, a 5-year drawdown, they hugely impair your ability to hit your objectives. And again, this is probably, you might be thinking like, yeah, duh. But the reason that this matters is if you have a long-term return objective or some sort of cumulative wealth that you're hoping to achieve over, say, a decade or some multi-year period, then when it comes to portfolio protection, if the shorter drawdowns don't really matter for your ability to hit your goals, and you're looking to protect your portfolio, or you're looking to sort of make your portfolio more robust to drawdowns or tail risks, then it's really the slow drawdowns that you should be spending your time and kind of research budget figuring out. Those are the ones that are going to be more valuable to your portfolio, assuming you have some sort of multi-year, in the example of the paper, a 10-year return horizon, and you're looking to achieve some average expected return. So that was kind of the simple, but maybe kind of deep insight that paper focused on. Is the speed of a drawdown matters to your final wealth outcome. And because of that, it helps you figure out what would be the most valuable source of portfolio protection or risk mitigation that you can introduce to your portfolio. And just like you alluded to, Dean, options can do a pretty effective job with the shorter, faster, crashier drawdowns. It's harder to build an option strategy that delivers for the kind of multi-year or kind of continuous periods. And so what we focused on in that paper was, okay, well, what are the types of things that tend to deliver in those longer, those protracted, those slower drawdowns?
Yeah, diversification is really the holy grail. If we can find some combination of assets that can weather the storm, it's especially important to be able to put those together. And so let's talk about this strategy called trend following and the way in which it tends to interact with, let's just say, risk assets, and maybe we'll just say the S&P 500, but that set of assets that tends to be pretty correlated, whether it's the S&P, credit spreads, and so forth. So first, maybe give us some understanding of what trend following is, just a brief overview, and then just with regard to its implementation and the way in which it tends to produce pretty efficacious results, especially in downturns, as a mitigator of risk. Walk through your results there and your thinking there.
AQR, I think, over the years has probably written and published more on the topic of trend following, or sometimes called managed futures, or academically called time series momentum. I think we've published more than anyone else, but here's the gist. Markets have a tendency to trend. Returns tend to have some persistence on average. It's not perfect. Just because something's going up doesn't mean it always will continue to go up. And just because something's going down doesn't mean it will always. But there is this sort of general tendency in our papers, our academic papers, to kind of test and show the efficacy of a trend following strategy. But generally what we do, we come up with a very simple one. We look at the past 1 month, the past 3 months, and the past 12-month performance for an asset class. So say the S&P 500 or the FTSE or the DAC, or you can do it in commodities or currencies or interest rates. You just look like, okay, what's the trailing performance over the past 1 month, 3 months, and 12 months? And we just sort of blend those all together. And that gives us a sense of, has this thing been trending up or down? Okay, so here's the rule that we impose in our simplified trend following or managed futures strategy. If the thing has been going up, you go long. If the thing has been going down, you go short. I'm guessing you might have this sort of knee-jerk University of Chicago, like that should not work. It tends to work, and it tends to work pretty well. So I guess 3 things with trend following. One is that on average, over long periods of time, this fairly simple, fairly straightforward strategy. It seems to work on average. It tends to have positive risk-adjusted returns, positive Sharpe ratios, positive returns for the risk that you're taking. Point two is that it is one of the few asset classes or strategies that we can find, that we have found in research, that tends to do well during periods of macroeconomic uncertainty, or we sometimes more colorfully call it macro turmoil. It's a pretty good strategy for bad times. And that leads to the third and final point, which you alluded to. In geek terms, it is a convex strategy. It tends to do particularly well when other markets are doing particularly poorly. So it's related to liking macro uncertainty and turmoil, but it's a little more direct than that. And that is when markets are going from bad to worse, this strategy tends to have its best times. In other words, delivering potentially, and at least historically looking at the data, delivering its best times when you need them the most. And so that's one of the sort of attractions of the strategy when it comes to our research, particularly our research when it comes to drawdowns and tail risk and these other risk mitigating strategies that people are, I think, re-underwriting given what we've seen last year.
One of the things I was listening to in preparation for this discussion was your podcast, the Curious Investor podcast, and having Cliff himself as the guest and talking about the momentum factor and taking it back to his days, as he called himself, a grad student in the early 90s at the University of Chicago, and finding, I believe it was more of a longer term momentum factor. But in describing some of the potential explanations for it, there's this idea put forth of just underreaction. Good news hits the market moves, it incorporates the good news, but it won't incorporate all of it. Love to have you talk a little bit more about that and just a little bit more about how AQR thinks about the why of this performance. Again, we're all from the University of Chicago. We take market efficiency pretty seriously. And here you have something that, boy, it's got some real attractive characteristics. It's delivering, on average, positive risk-adjusted returns, and it's also delivering this convexity in times of, as you say, macro turmoil. Boy, that's a beautiful combination that almost feels like we've struck gold. And as University of Chicago grads, we're sort of taught to think that, boy, that's hard to find as well.
I share maybe your well-veiled cynicism. Why should it be that you can find a strategy that delivers positive expected returns, but positive long-term average returns, and deliver especially good returns exactly when you need them the most? From a pure, rational, efficient market standpoint, you shouldn't be able to find many of those. You shouldn't be able to find something that gives you returns, especially when you need them, and you kind of get paid to hold it. Something that works on average and when you need it the most. You need to try really hard to come up with a good explanation for what is driving that behavior. And I think you've got your rational kind of efficient market school and you have your inefficient or irrational school. It's difficult to explain what's going on using rational, efficient markets theory here. Underreaction, what you alluded to, and kind of subsequent bandwagon effect seems to be the most intuitive explanation for what we find with trend following. So you're right. So let's say some good news comes out about an asset class, maybe in the US, we have a positive growth surprise. Markets should, in theory, go up to reflect that kind of good news, but maybe they don't go up fast enough. Maybe people are kind of slow to incorporate that new information. And so it starts to go up slowly. I mean, it goes up. Good news has come out, but prices haven't gone up quickly enough. Then what happens as the price starts to go up? Well, then you could have sort of this bandwagon effect. So you kind of start with underreaction, but as this trend starts to form, more and more people want in on that trade. So you get this sort of delayed overreaction, and it causes some persistence. If it kind of gets too far out of hand, then you would expect the trend to die and maybe mean revert a little bit. Cliff is fond of saying, don't be a momentum investor to value horizon. Following 3 to 5 year trends is generally a bad idea that kind of fights against value. But following trends at these sort of shorter horizons, 1 month out to 12 months, empirically tends to be a good idea. And it's probably because you're capturing this underreaction. Now, I will say, doing a strategy like this in a single asset class is not a very good use of anyone's risk budget. This sort of trend following represents an edge, a source of alpha, if you'd like, but a small edge. For us, the way to magnify the efficacy or the Sharpe ratio or information ratio of the strategy is to do it everywhere. So not just trend following in equity markets, but doing it in commodity markets, currency markets, interest rate markets. We have, since kind of our early days with this strategy, also broadened it to what we call alternative assets. So more niche-y, kind of less traded places where we didn't even look in our original research also shows a tendency, and a very strong one, to trend. We've also looked beyond just price trends. What about what we call fundamental or macro momentum? Same idea. If there is a tendency for market participants to underreact to news, then you should expect to find it kind of everywhere you test. And that's what we do. And whenever we find something that seems to work in a lot of places, as a firm, we love it because it means we can kind of add more and more of those places to our actual strategies. And we expect higher risk-adjusted returns for doing so.
Of course, you founded in US equities, and then you go around the world and other equity markets, and then across the asset classes. And it's just so interesting how persistent this behavior is across the asset classes. So that's some very interesting stuff. And I'm sure it keeps you guys very busy in looking for the next expression of this. So we've been talking a lot about diversification, and I think it's just obviously a critical issue for investors. We've seen just how correlated assets can become in downturns. And so finding some form of diversification is critical. And some of your recent work is on this idea of international diversification. You guys have published some recent work, and the starting point is essentially acknowledging that, I think you say, for the last 3 decades, the US has been the place to be, and that efforts to diversify internationally have been essentially an opportunity cost, just given how good the US has been. But you're making a call to say that that's behind us, and on a going forward basis, you see a much better opportunity set with regard to international diversification. Why don't you walk us through the work, how it kind of came to you guys taking a stand effectively, and then we can ask some follow-up questions.
For this one, I think part of the impetus or maybe inspiration for these papers, so one on international diversification, call it broadly, that was with Cliff Asness and then Antti Ilmanen, who's also in the Portfolio Solutions Group. And then one specifically on emerging markets, which was co-written with Michelle Agassi. I think they came from a common place, and that is, in speaking with investors over the past couple of years, it's hard not to notice that many of them, if not most of them, have an overweight to US markets versus the world, versus other international developed or emerging. And today, to AQR anyway, seems like a particularly bad time to have that US overweight. And so we wrote these 2 papers to kind of, remind or maybe motivate the case for international diversification when it comes to folks' equity holdings. And you're totally right. Diversification is never the way to win friends. I think it's probably even less attractive today than it's been in a long time because, the US market in general have trounced international equity markets. I think in the paper, we show that US versus EFA, since 1990, the US has outperformed by like 4.6% per year. That is a really long winning streak for an investor to choose to be kind of short or on the other side of today. And so what we do is we say, okay, well, let's take a look at the case for international diversification in a few ways. Let's take a look at it from a kind of a risk perspective. Let's take a look from a return perspective. From a return perspective, one of the things that we do in these papers is take a look at valuations. And the reason we do that is we want to get an understanding of how much of the return advantage, so that 4.6% number, how much of that can be attributed to the US winning on fundamentals. So you can think of earnings growth versus how much was just because of valuations. How much was because the US just got more expensive. People are willing to pay more for $1 of earnings in US markets than in other places. So one of the things that we do in the paper is we say, okay, let's control for changes in valuations, changes or how much more expensive did the US market become. And over that sort of 30-year period since 1990, if you look at valuation multiples, and what we do in the paper is just look at the Shiller cyclically adjusted price to earnings, so the Shiller CAPE, the US market in 1990, it had a half the relative price to earnings multiple as IFA. At the end of the period, 32 years later, it was 1.5 times IFA. In other words, the US on a relative basis got 3 times more expensive on the sort of earnings adjusted basis compared to international developed markets. Once you account for just the fact that the US became more expensive, you find a statistically insignificant edge for US markets. It falls to something like a 1.2% per year. What in terms of like thinking ahead, looking forward here, if you think the US is going to enjoy a similar advantage going forward, you're basically assuming, roughly speaking, another appreciation in valuation. You're expecting the US to continue richening, kind of 3x. You're sort of the same path over the next decade or next 30 years as we saw in the last. And we just don't think that's going to happen. It's highly unlikely. It's not written in the stars that the US is going to be the best performing equity market going forward. And in fact, it has never been the case. If you look at the past 5 decades of equity market returns, the US actually underperformed IFA in 3 of them, just because of the most recent decade or couple decades performance. I don't think that means that we've learned anything about how the US should perform in the next one.
Now, when you step back and you look at that change with regard to valuations, and you say the US has become 3 times more expensive now versus the beginning from the early 1990s, have you thought about the why of that? Is it tech innovation in the US that maybe we don't see as much of in Europe, or the European broken banking system? I mean, are there reasons or some potential causes for this that you look at and say, okay, well, we can understand some increase in relative valuation, but 3x just seems too high? How have you guys looked at that?
We've tried to get under the hood on that and figure out, okay, ex post, what happened here? One is earnings growth. Earnings growth over the past, just to say the past decade, was far stronger in the US than in other regions in general. And so I think that's one of the reasons that the US outperformed more recently, again, this is the past decade or so. But that doesn't tell you enough. That can only explain a portion of the advantage. It really seems to be more of this valuation multiples story. This is just going to be kind of speculation at this point, but it kind of gets back to Cliff's don't be a momentum investor to value horizon. I think what we find, and when I speak with investors, is a lot of maybe end investor decisions are based on realized returns. And if a market has outperformed over the past 3 to 5 years, the history of investing, the history of empirical finance suggests, if anything, you want to be underweight that thing going forward. But that's not how most people behave. And this might be one of the reasons value exists, is people extrapolate over these kind of longer or called intermediate horizons. And I think it's been a little bit more of a not so much performance chasing, because that tends to be kind of a shorter phenomenon thing. But I think a lot of people just look at the past few years and say, okay, that's probably going to be my baseline for what to expect going forward. So yeah, there's a little bit of a fundamentals advantage recently, but not enough to explain what's going on. It's hard to explain kind of rationally.
So some portion of international diversification, you guys are advocating to be taken on through exposure to EM. So that's another piece of research that you guys have published. Talk to us about what you're seeing there with regard to its attractiveness, and then maybe be specific about where that EM exposure should come from.
The paper that we wrote, it came out just a couple months ago, argued for both a, call it strategic, and also a tactical case for emerging markets today. The strategic case was similar to the strategic case for international developed kind of more broadly. And that is emerging valuations are low compared to US. In fact, I think we wrote that they're generationally low. And one thing you can do is you can sort of say, okay, well, what's the expected return for emerging markets compared to developed markets based on things like earnings to price ratio? So kind of let's go back to the Shiller PE. And what we find is today it's at the upper end of the range that we've seen over the past 25 years, suggesting that emerging markets are priced to deliver higher expected returns versus developed markets than we've seen anytime in the past few decades. And I think this matters for investors. Another part of the analysis we did was to think about, okay, well, how much exposure do investors have to emerging markets currently? One of the things we looked at was eVestment data here. So this is sort of a database of institutional money managers. And we pooled all the holdings and we mapped them to, okay, how much of managers' holdings are in emerging markets overall. So just a big picture aggregating all these things. And what we find is that they are about 25 to 30% below the global market cap weight. In other words, there's a sort of meaningful underweight there. Through active management, a lot of investors, we believe, are underexposed to this opportunity, this kind of valuation advantage or expected return advantage that we think emerging markets are going to deliver over the next 10 years. The more tactical side of it is specific for value investors. Going one level deeper here, if emerging markets look more attractive than developed markets from a valuation perspective, we're also saying, okay, let's now drill down within emerging markets. There's also a case for value. And the way we quantify that is through something called the value spread. This is a statistic that AQR actually came up with back during the tech bubble, because we needed a way to understand and explain and to quantify what was going on, the craziness then. And it's been a helpful measure for today because we see this as stretched, and in fact, in emerging, even more stretched than we've ever seen in the past. The intuition for the value spread is let's make this simple. Let's just take all of the stocks in a given industry, in a given country, and you just kind of split them into two groups, the expensive stocks and the cheap stocks. And then what you want to do is you say, okay, well, what's the valuation? How expensive are the expensive stocks and how cheap are the cheap stocks? And then you just look at what's the ratio of the two. And I like to think of the value spread as kind of a rubber band. When that ratio gets really stretched, what it means is that the cheap stuff is way cheaper than normal compared to the expensive stuff. The reason I like to think of it as a rubber band is if you ever kind of stretch a rubber band, if it's really stretched, it's almost like this force that kind of pulls you back in. But in normal times, you don't really kind of encounter that much. The value spread in emerging markets is historically high. The difference in valuations between the cheap guys and the expensive guys is beyond what we've seen in the past. And we think that's the additional tactical opportunity for active management in emerging. So to your question, how would you play this as an investor? If you do think that valuations are a useful input to the portfolio, the asset allocation decision, or the portfolio management decision, what would you do? Well, one, like most investors that I've spoken with, maybe get rid of that underweight to emerging, increase to at least be neutral on a global cap weighted perspective. If you think that relative valuations can be a source of value add and a source of alpha, source of excess returns, then maybe you'd want to actually lean in and have a little bit of an overweight to emerging. And you could just do this even on a passive basis in order to get that valuation advantage. For an active manager, we think the opportunity set is even more attractive than that. And what you'd want to do is find some sort of value-oriented strategy in emerging markets. We tried to actually quantify what we think the advantage is for a value-oriented emerging active manager. And we think it's going to be something like a 3 to 6% tailwind over the next 2 to 3 years as this valuation spread normalizes. And big picture, we're living in a world of fairly low expected returns. A lot of assets are expensive. Anywhere you can find a tailwind today is sort of more valuable than average. And so this is something that we're particularly excited about.
When you step back and try to think of the why of this historically wide valuation spread, let's say in EM, I'm just thinking back to the late 2020 into 2021 period and the way in which US valuation spreads had stretched to either all-time wides or near all-time wides. You'd know better than I would, just incorporating the tech bubble. But there was, I think, an explanation for that, or at least something you could easily come up with in terms of the COVID shock and work from home, and everybody wanted to be on Zoom and Peloton and so forth. It was the manner in which the pandemic had so profoundly changed our lives, maybe because rates were so low. There was a lot of things thrown out there. We're a couple of years past that now. Any ideas just in the realm of EM, why those valuation spreads are so historically wide?
It's a tough question. And I think you're right in that sometimes it's easy to explain, maybe not during, but after the fact at least, why markets just seem out of whack, why valuations seem just so divergent. The tech bubble, as an example, sort of the occasion for this statistic, this measure to have come into existence. I think the tech bubble was pretty aptly named. It was the entire, with some exceptions, the tech industry was at crazy valuations versus other industries. But the value spreads, the statistic that we're talking about here is country and industry neutral. In other words, it's not because we think that one emerging country is way cheaper than another, or maybe technology is way more expensive than other industries within emerging markets. What we're doing is we're looking within every industry, in every country, the expensive versus the cheap stocks, and kind of putting all of those together. So it's really hard to reconcile what we're seeing with kind of an easy single line answer. One of the things that we do look at is, okay, well, could this be justified? Could the dislocation today make sense in some way? So, okay, what's going on with the cheap stocks? Are they just crummier companies? Just fundamentally, are they worse? Maybe the expensive stocks just have growth expectations that they're plausibly defensible. So for instance, one of the things that we look at is, okay, well, if today's environment, if today's dislocation between value and growth stocks is justified, what would the growth rates have to be? Think of like earnings growth for cheap stocks versus expensive stocks in order for prices to make sense today. And so in the case of emerging markets, for prices today to be, call it rational or make sense or just justified, you would need the expensive stocks to have growth rates that are twice as high as we've ever seen in all of the data that we've seen for growth stocks to have. We just think that's unlikely. And that's more than 4 times the average growth rate that growth stocks have had compared to value stocks. And so that's what you would need to justify what we're seeing. Then you can kind of take a look at, okay, what are analysts' expectations? What does the market actually expect these things to have? And analyst expectations are just historical average growth rates. So in the case of this value spread, this value dislocation, we've looked really hard to figure out, okay, is there a reason that this could be kind of the new normal, if this location makes sense today? We can't find it. So that leaves us with thinking this is most likely, I know it's sort of a charged word here, but a bubble, a big opportunity that can't be explained fundamentally, and one that we think is worth taking advantage of.
There's the old Warren Buffett adage I tend to say all the time: price is what you pay, value is what you get. A lot of really attractive looking stocks out there, but the price may already well incorporate tons of good news. So it makes it difficult. Even if the stock is a great company, it doesn't necessarily make it a great investment. There's the other saying, there are no bad securities, only bad prices. I like that one too.
Yeah.
Dan, this has been a great conversation. I certainly learned a lot about what your group is up to, and really find some of the insights on trend following and just this overall notion of diversification. I think especially post the disappointment of duration as a mitigator in 2022. Maybe that changes, but certainly caught a lot of people off guard last year. So finding other strategies, whether it's through things like trend following or going around the world and looking for a little bit of diversification from international exposure, I think that's time well spent as well. So thank you very much. I think this has been an excellent conversation, and our guests will appreciate the insights.
Great. Thanks so much, Dean. This was fun.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.